Welcome back to Investing Talk podcast. Today, we are looking at a situation that is pretty much the definition of market whiplash. We're talking about a stock that spent the first part of the year riding the absolute crest of the artificial intelligence wave. It surged nearly 40% year to date, looked totally unstoppable, and then just in the blink of an eye, it gets absolutely slammed, a drop of 17% in a single session.
Yeah, it's the kind of volatility that makes you check your screen twice
Yeah.
just to make sure it's not a data glitch. One minute you're the darling of the sector, the next you feel like you're in the penalty box.
Exactly. And it sets up this massive tension-filled debate that we really need to get into today. Is this company just a quote-unquote pre-revenue science project
Yeah.
that's just going to dilute its shareholders into oblivion to keep the lights on? Or, and this is the argument I know you've been looking into, is this actually the hidden backbone of the next generation of AI data centers? And is this drop the buying opportunity of the year?
That really is the multi-million-dollar question, isn't it? Because when you look under the hood, this isn't just about stock price fluctuations. It's about a fundamental shift in hardware physics.
Okay, so let's not keep everyone guessing. Today is all about Pewit Technologies.
Right. And to be clear, for everyone listening, despite the name, this isn't poetry. This is photonics. We're talking about the hardware layer that is physically required to make AI chat, compute, and transfer data at light speed. It's the plumbing of the AI revolution.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us keep these breakdowns coming. Okay, so let's bridge the gap here. We have to start with the fundamentals because, honestly, when I opened the financials on this thing, I had to squint to find the revenue line.
I have a feeling I know which number you're looking at.
I mean, I'm looking at the revenue. Or, more accurately, the lack thereof. We have to bring up the stark financial reality here. If you look at the trailing 12-month revenue, we're talking about roughly $762,000 US dollars. And in the most recent quarter, it was something like $298,000. That's microscopic. That's the revenue of a small corner store, not a semiconductor revolutionary.
It is undeniably early stage. There's really no sugarcoating the top line right now. It's a pre-revenue story for all intents and purposes.
Early stage is one way to put it, but then you look at the burn. You contrast that tiny revenue with a net loss of roughly $50.5 million over the trailing 12 months. EBITDA losses are sitting around $7.8 million. So despite this massive AI narrative we keep hearing, trillions in spend, NVIDIA printing money, this company is just burning cash with very little coming in the door. How do you reconcile that?
You reconcile it by understanding what they're actually building and, more importantly, why it's so hard. You have to look past the current P&L and look at the moat. The whole thesis here, it revolves around the P08 optical interposer platform.
The optical interposer. Okay, let's unpack this. That sounds like Star Trek technobabble to the average investor. What does that actually mean?
Okay, so think about how electronics are made today. They're printed on silicon wafers, right? Billions of transistors. It's automated, cheap, scalable.
That's Moore's Law.
That's Moore's Law. That's why your phone is so powerful. But photonics, using light to move data instead of electricity, has traditionally been the complete opposite. It involves manually wiring optical components together. You've got lasers, lenses, mirrors that all have to be actively aligned.
Actively aligned. What does that even look like on a factory floor?
It means a human or a very, very expensive high-precision robot has to literally turn the laser on, hold a lens in front of it, measure the light, and then wiggle it around until the signal is perfect, and then glue it in place.
So it's like building a car by hand versus on an assembly line.
Exactly. It's artisanal chip making. And P08 changes the physics of that manufacturing. Their platform allows for wafer-level integration. They call it the semiconductorization of photonics. They can place the photonics and the electronics on a single chip without all that active alignment. It's passive. You just place it, and it works.
That sounds great on paper, but why does the market need this now? Why can't we just stick with copper wires or the manual optics we already have?
Because of heat and distance. This is really the aha moment for this whole thing. AI data centers are hitting a physical wall. They're moving from 800G speeds to 1.6 terabits and eventually 3.2 terabits per second. When you try to push that much data through copper, the resistance creates massive amounts of heat. And the legacy optics, they're too big and too expensive to put right next to the hot AI chips.
So the old way literally cannot handle the heat.
It creates a bottleneck. The DPUs, the brains of AI, are fast enough, but the plumbing connecting them is choking. POET's platform is designed specifically to solve that bottleneck. It's small, cheap, and cool enough to sit right next to the processor.
Okay, so the tech is the dream. It solves a real physics problem. But let's talk about the nightmare that just happened for current shareholders, the cash event. We just saw a $150 million registered direct offering.
Which is a significant amount of money for a company this size.
Huge. But they priced 20.7 million shares at $7.25. That caused immediate dilution. If you were holding the stock at $8 or $9, you just took a massive haircut because the company needed money. To me, that signals distress. It signals we're out of cash, so we are raiding the shareholders' pockets.
See, I view that completely differently. I would reframe that as a war chest.
A war chest. That sounds like corporate spin? Convince me.
No, hear me out. Before this raise, what was the #1 bear case? It was they're going to run out of money before the tech is adopted. They were bleeding $50 million a year with no revenue. By securing $150 million, they have effectively removed the fear of bankruptcy for at least the next 2 to 3 years. This funds their R&D, it funds potential acquisitions, and it lets them scale without looking desperate.
So you're saying the dilution was the price of survival?
It was the price of stability. You can't negotiate with a trillion-dollar company if they think you're going to go bust next month. And here's the key detail you might have missed. Look at the gross margin on those early sales, meager as they were.
It was 100%, right.
100%. Because a lot of it is licensing and engineering services right now. That signals that once they actually scale this, the profit potential is massive because their cost of goods is so low compared to the manual assembly guys. They're designing blueprints, not building factories.
Okay, assuming they can sell it, that's the hurdle.
Yeah.
Who is actually buying this? Do we have names, or is it just unnamed Tier 1 customers?
Oh, we have names. Validation is there. You've got Celestial AI, which is huge because they're deeply connected to the Broadcom and Marvell ecosystems, the big boys of connectivity. You have Mitsubishi Electric, a giant in lasers. You have Sievers Semiconductors. These are not small players just kicking the tires. These are major industry heavyweights engaging with the platform.
All right, so the tech is promising, partners are real, but the financials are, well, terrifyingly lopsided. Let's transition to the technicals because the price action tells a story of its own, and I want to see if the charts agree with your optimism.
It absolutely does. And even with this recent drop, you have to look at the context.
The context being that 40% gain we started the year with.
Right. Prior to the offering, the stock had broken out to multi-year highs. That was signaling incredibly strong momentum. The market was front-running the success story. And even after this 17% slam, you look at the structure, the stock is still trading above its 50-day and 200-day moving averages.
Which usually indicates the long-term trend is still bullish.
Exactly. The structure hasn't broken yet. It's bruised, but not broken.
But let's look at that dip specifically. It fell toward 633, bounced around that 725 level, but what really caught my eye was the volume. A massive spike, 11.8 million shares traded on the drop. That's way higher than average. To me, the skeptic, that looks like investors fleeing. That looks like the exit door getting jammed with people screaming, sell.
It looks like churn and accumulation.
Explain that. Why would high volume on a down day be a good thing?
Well, when you have a high volume drop like that around a financing event, it's often a changing of the guard. Retail investors see the price drop. They see the word dilution and they panic sell. But someone has to buy those shares. Who is buying 11.8 million shares on a red day?
Sophisticated investors.
Institutions. Funds who wanted in but didn't want to pay $9. They're scooping up the shares being panicked, sold at the offering price. They're anchoring their cost basis at $7.25.
So you think smart money is using the retail panic as their liquidity?
The volume suggests significant demand at these lower levels. The price didn't collapse to zero. It pinned right at the offering price. And if you look at the pattern forming on the weekly chart, it looks a lot like a cup and handle continuation pattern.
A cup and handle. For listeners who aren't chartists, that's usually a bullish setup, right?
It is. The cup is that long recovery from previous highs, and the handle is this exact pullback we're seeing now, a shakeout before the next leg up. If it holds here, the technicals suggest the next move is a breakout to new highs.
That's a bold call, given the bleeding balance sheet. But let's move to sentiment. What is the rest of the market thinking? Because it seems like the analysts are still singing a pretty happy tune despite the crash.
They are. Northland Capital, for example, they actually raised their price target from $7 to $8 right in the middle of all this chaos.
Which is above the offering price. That's a vote of confidence.
It is. And the consensus generally sits in the buy or outperform range, with targets averaging anywhere from, say, 583 on the low end to $8 on the high end. And it's not just financial analysts. The industry itself is noticing. Their Terralite product recently won a Product Innovation Award.
Industry buzz is good, I'll grant you that. But does a shiny plaque pay the bills? Companies win innovation awards all the time and then go bankrupt.
True, but in the semiconductor hardware space, these awards drive adoption. Engineers buy what wins awards because it de-risks their choice. If the industry says this is the best optical engine, an engineer at Google or Amazon is more likely to test it. But there's another layer here, the options flow.
Yeah, I saw this in the data. There was a surge in call option activity back in Q4. So people placing leveraged bets that the stock is going up.
And at the same time, look at the short interest. It's declining.
That is interesting. So the bets against the company are shrinking, even while the price volatility is rising.
Exactly. It creates this sort of hidden bullish divergence.
Right.
If the shorts believed this financing was the beginning of the end, that the tech was a dud, they would be piling in right now to drive it to zero. But they're not. They're covering. They're getting out of the way.
Maybe they're scared of the rumors. We have to address the speculation because the rumor mill is spinning on this one like a centrifuge.
It always does with deep tech stocks.
There's this unconfirmed buzz about M&A, specifically that the Celestial AI deal is fueling takeover chatter.
It makes sense logically. If you're a major chipmaker, think Broadcom, NVIDIA, Marvell, and POET owns the only way to make your chips talk to each other efficiently at 3.2 terabits.
You just buy them?
Why not just buy them? Why pay licensing fees forever when you can own the IP?
It's the classic build versus buy calculation.
And POET's market cap, even after the raise, is a rounding error for those giants. It would be pocket change to acquire them.
And what about this talk of a tie-up with Quantum Computing, Inc.?
Again, speculative. But photonics is absolutely essential for quantum computing. You need to control light particles with extreme precision, and POET's interposer is perfect for that. But let's stick to what we know. The timeline for confirmed news isn't that far off. The market is looking at the first half of 2026 for Sivers prototypes and the OFC conference, the big optical conference, for new demos. So we have hard catalysts on the horizon.
Okay, I've let you paint the rosy picture. You've got the tech, the chart patterns, the M&A rumors, but I need to do my job here. We have to transition to the risk segment. I have to play the bear because there's some serious red flags here we can't ignore.
Go for it. Hit me with the bear case.
First, execution risk. They are competing against absolute giants. Intel, Cisco, they have their own photonics divisions. POET is trying to change the manufacturing standard of an entire industry. That's not easy. It's David versus Goliath, but Goliath has billions in R&D.
That's a valid point.
Second, valuation. Even after the drop, it is trading at a price-to-book ratio of 13.9. That is incredibly expensive for a company with no profit. You are paying a massive premium for hope.
Also true.
And third, the dilution. That $150 million offering, it hurt early shareholders. It creates an overhang. If they burn through this cash without significant revenue ramps by 2026, the stock could collapse. What is the defense against that? Why shouldn't I just wait?
These are all the right risks to highlight. But here's the bull rebuttal. First on execution. Look at the market size. The demand for transceivers, the devices that send and receive data, is projected at 31.9 million units in 2025 alone.
That is a lot of units.
POET does not need to win the whole market. They don't need to kill Intel. They only need a small slice of that 31.9 million to justify this valuation. If they capture even 5 or 10% of that market with their optical engines, the revenue math changes instantly. They go from 700,000 in revenue to hundreds of millions very quickly.
What about the financial health? You can't pay employees with market share potential.
Their debt to equity is low, around 9.8%. They're not drowning in debt payments. And now, thanks to the offering you hated, the balance sheet is fortified. They have the runway to get to that 2026 adoption curve.
And the margin safety.
This is the critical part. They operate a fab-lite model.
Explain fab-lite for the listeners.
It means they outsource the heavy, capital-intensive manufacturing to a foundry in Malaysia or China. They don't build the factories themselves. This keeps their overhead drastically lower than a competitor who has to build and maintain their own billion-dollar foundries. They can survive leaner times better than the giants. They're nimble.
So you're saying they're built for this exact moment in the cycle high innovation, low capital expenditure.
I'm saying they are structured to survive the valley of death between R&D and mass production.
All right. We've looked at the ugly financials, the beautiful tech, the scary dilution, and the massive potential. It is time for the verdict.
Okay.
I remain skeptical of the timeline. I think 2026 is a long time to wait for revenue to ramp up while they burn cash. I've seen too many promising tech companies bleed out before the market catches up, but I will admit the cash position is much, much safer now than it was a month ago. They are not going bankrupt tomorrow.
And that is key. My final verdict is based on the research and the asymmetric upside here.
Give me the score.
I'm assigning a bullish score of 8 out of 10.
8 out of 10. That's high for a company with $300,000 in quarterly revenue.
It is high. And the rationale is simple. The technology, the optical interposer, is a legitimate moat. It is a proprietary solution to a physics problem that the entire AI industry is facing. You cannot cheat physics. Data centers need to move data faster and cooler. POET solves that. The dilution we saw is temporary pain, but it funds the future.
So you see it as buying the dip on the future infrastructure of AI.
Exactly. It's a volatility tax you pay for getting in early on a potential standard setter. If this works, it's not a 2x return. It's a standard for the entire industry.
Well, there you have it. An 8 out of 10, despite the red ink on the balance sheet. It is definitely a high-risk, high-reward play. If you enjoyed this breakdown, make sure to subscribe to the channel, leave a comment below. Are you buying a dip or staying away? We want to hear from you.
Thanks for listening.
See you in the next deep dive.